Can you use your home equity to help survive retirement? It's a big question, especially in today's economy where interest rates are going up, stock prices are going down, and man, you see the price of eggs and gas and milk and anything you want. Everything is, prices of everything are increasing, your assets are depleting. So can you use your house? Can you use some of the equity or the value in your home to make it through retirement? Well, my name's Jason Eichmiller. I run this channel, Reverse Mortgage Reality, and I've been doing reverses and I've been helping seniors look at and, when appropriate, use their home equity for retirement since 2008. So that's over 450 seniors. So glad to give you some information right now. If you do need me, well, I do have a whiteboard behind me. Probably would have been smart to write my phone number there, but you can't read my chicken scratch anyway. My phone number, if you want to contact me and talk through your situation, is 888-309-9705. Again, 888-309-9705. Or you'll see that my email address and my website all below. By the way, the website is www.reversequotes.com. So that's how to reach me if you'd like to reach me. So let's talk about home equity and let's talk about inflation and kind of why that's needed. So right now, in today's world, we know that interest rates are up. We know that everything costs more, and we know that the market has depleted. So if you're retired or you're in your early 60s and you're thinking about retirement, this is going to ring true, and you're going to feel it, and you understand that better than I do because I'm still a working stiff. I'm 42. I got to keep my 401ks and stuff are down, but I just got to keep hustling and working and helping folks and throwing money in. I don't have to worry about it now. But if you do have to worry about it now and you're taking money out of your assets or you haven't really prepared for retirement, then you might be looking at your statements and your money going in and your money coming out and saying, geez, this is pretty rough. So let's talk about using home equity. Well, statistically, back in about June and July of last year, when home values were at their maximum, and different areas are a little bit different, but in a nutshell, at a high enough level, home values topped out kind of middle of last year before they started that interest rate hike. Seniors had an explosive, they had more equity in their home than they ever had before. And still, even in early 2023, where yes, you might not have quite as much equity, but it's still a historically massive level, right? You probably understand that. You can just go on Zillow.com and look at your home value. And don't take Zillow with a grain of salt. None of those sites, Zillow, Redfin, any of those, none of them are going to be perfect. In fact, if you want to get a valuation of your house, feel free to reach out to me and I can go ahead and look at, I've got a couple neat little proprietary tools that I can use to help you figure out how much your house is worth. But what equity means is it's just the value of your house right now minus anything that you owe on it. And so I'm going to go over, this is a guy I helped a couple weeks ago. He's a dear friend to me now. He came to me as a referral, and his friend Mike actually used a reverse in the exact same way. But my dude Oscar out in California, he's kind of the perfect example of somebody who decided to use his home to be able, and his home's value and his home's equity, to be able to live in his house for the rest of his life, at least financially comfortable and stable. So he loves, by the way, he loves where he lives. He's up in the mountains. He can go skiing. He actually does cross country and downhill skiing. He's a runner. So he's a very, very active guy, kind of lives out in a very kind of like a luxuriously, how do I explain it? It's one of those areas, it's like kind of a resort town. That's what it is. It's a resort town. And he lives very well there and he loves nature and he's never moving away ever. House is on the golf course too. I mean, he's doing all right. And he didn't have a mortgage. He's 62 and he didn't have a mortgage on his house, right? So 62, free and clear, but he doesn't have a ton of money in his assets. Not a ton of money in the bank, not a ton of money in investments. So we were kind of thinking, like, can we use this reverse mortgage to create this line of credit that's going to grow and grow and grow, and that he's going to be able to tap and use anytime he needs to for retirement. So it's going to pay his property taxes and his homeowner's insurance, and it's going to supplement his Social Security and his other retirement income. So that's where we needed to get to, and that's the reverse mortgage line of credit. Again, it's a safety net. It's a side account that grows tax-free year after year after year, and you take it down the line whenever you need it, and that money's there. And yes, it's tax-free, so you don't have to pay on it. So what we did was, I'll go over and I'll try to get his numbers pretty close to right because it's been a couple of weeks. But his house appraised at $745,000, and he didn't have a mortgage on it. So he was able to open up, and the lines of credit that you can open up now with reverses, because interest rates are higher, they're not as big as they used to be, but they still have that power of compounded growth, which I'll share with you in a second, to get really powerful down the line. So what he was able to do is he opened up, I think it was, $245,000 in his line of credit. And that's growing somewhere in the high 7% every single year. And they can't stop the growth. They can't halt the growth. The reverse mortgage bank, because it's backed by the FHA, they can never say, wait a minute, this line of credit's too high, you can't have it. As soon as it's locked in for life, or as I like to say, forever and ever, amen. So it's 245. At the end of the first year, it's going to grow to approximately, and I'm saying approximately because as the interest rates go up and down, the line of credit growth is going to follow them. So after the end of 1 year, it's going to be about 261. So from 245 to 261. At the end of 10 years, it's going to be about 469. Again, from $245,000 to 10 years down the line, $465,000. Then at the end of 20 years, let's say, and he's only in 20 years, my guy is only 82. So he's got a lot more living to do. It is now $899,000. Now, a couple things. So by the way, $899 from 245, that's pretty solid. Now, how can it grow that way? Or I guess I should say, how can you screw up the growth? Because people ask me like, well, is that growth guaranteed? Well, growth on it is guaranteed, but again, I can't tell you exactly what rate it's going to grow at, because as rates go up, it's going to grow faster, and as rates eventually come down, it's going to grow a little slower. So I hope you understand that. So how can you screw it up though? How can you screw up a line of credit? First of all, it's this $899 after 20 years. If he doesn't take any money out of it. So the first thing you've got to do is if you're really using this as a retirement safety net, you've got to be responsible with it. Now, every dollar that he takes out, so let's say he takes $1,000 out of it, right? Well, that's going to decrease the line of credit by $1,000. So let's say it's in the very beginning and it's $245. Let's say he takes $1,000 out of it. Now it's $244. Well, now it's the $244 that's growing at that rate instead of the $245 that's growing. Use an egregious example. Let's say he took out $100,000. So now it went from $245 all the way down to $145. That's a better example, I think, for you to conceptualize. That $145 is now growing at the 7-point-something% instead of $245,000 growing. So that's a difference of about $7,500 in the first year of growth. And as you get farther downstream, down the hill, whatever you want to say, then that will expand, and because it's compounding growth and compounding growth and compounding growth. So if you need the money, like again, I think he's going to use it for property taxes and homeowners insurance. So his overall growth is going to be dropped a little bit because of using it for those items, but it's still the money that's left over there. That's 7-something% growth year after year, and not getting taxed on it is pretty awesome. Like we ran the numbers after we had kind of the plan. Once the appraisal came in, the plan was through, and he is absolutely confident that at his lifestyle, he's not going to outlive that money. That money is going to be there forever. And again, he wants to be in that house forever. So he's like one example, but it's fresh in my mind. It just helped him. So I wanted to use him as an example of somebody who uses their home value without a whole bunch of other stuff. He's the one who used his home, his value, his equity that absolutely set his retirement up. Now, you might be saying, man, he's free and clear. What if I owe a balance on a mortgage? Can this still work for me? That's where this gets tricky. That's where it's kind of an issue by issue. If you don't have a mortgage on your house, then this line of credit is damn near foolproof. Call me, we'll go over figures, but there's not a lot of thinking you put into it. Like, hey, I'm gonna open up a line of credit. If I don't use it, I don't owe it. And if I don't use it, then it's gonna grow like a weed. So if you have a mortgage though, or if you have a lien on the house, that's where, again, it gets we have to look at it case by case. Now, with a reverse mortgage, anytime you have anything secured to your house, meaning a lien, a mortgage, whatever, if you owe it on your house, then we have to pay it off. So if it's, let's say that Oscar owed $100,000 on his house, just making these numbers up, he didn't know anything. If he owed 100, then we would have had to use the reverse to pay off that $100,000. Then, instead of having that line of credit of $245, because we subtracted 100, now we only have the line of credit of $145. It's still growing at the exact same percent, but the growth is a little less powerful. So let's say that now of course he would, in that case, let's say his mortgage payment on that $100,000 owed was $900 a month. Well, he is saving that $900 a month. So he's taking that money from the mortgage company's hands and keeping it in his piggy bank. And here's something that's very advanced actually, that I don't think I've taught this before, and I don't see it anywhere on the internet. So with this line of credit, if you pay into it, meaning let's say that you get the line of credit, it starts at $300,000, right? If you put dollars into the line of credit, if you pay into it, then it'll grow by that amount. So let's say you have a $300,000 line of credit, and every year you want to put in $5,000. So you'll pay $5,000 into it. That is now going to go from $300,000 to $305,000, and that will rip around 7%. So it's kind of maybe it's a tough one to conceptualize. So if you have any questions, go ahead and type them below, or you can go ahead and reach out to me. I'm glad to explain it for you. So yes, if you owe something on the line of credit and you pay it down, then the line of credit will go up. It will increase by the amount of money that you paid into it. It's pretty smart. Not a lot of people do it because they just say, hey, I'm cash flowing good. I want to stick that money into my back pocket. But if you truly, truly want to maximize your line of credit, that's a little strategy that you can use. So hope this makes sense. It's 13 minutes and I didn't expect to go this this long. But listen, if you have equity in your house, and if you're watching, you probably do have equity in your house, and if you're looking at your savings, you're looking at your portfolios, or you don't have much of those, and you're thinking, man, how am I going to get through this thing called retirement? It's worth it. It's absolutely worth it to look at your home equity. All right. I'd be glad to help. I'd be glad to give you projections and proposals. If you talk to anybody that I've helped, there's no pressure. Heck, I don't even know if a reverse is right for you or if you can qualify until we spoke about it, until I ask you probably 1,000 questions. But the more I know about you and your situation and what you need, the more I can advise you on whether, hey, number one, can you even do this? And number two, is this smart for you to do or not? And there's never any pressure, okay? So you would like to get in touch if you want to see if you can strategically use your home equity and it can help you live an easier, freer retirement, and you can be confident that you actually have that safety net, then feel free to reach out. Again, my name is Jason Eichmiller. I run this channel. I run Reverse Mortgage Reality, own Key Home Lending. That's our broker. By the way, we are a mortgage broker. I contract with all the big reverse mortgage companies, and just whoever's going to give you the best deal is the one that we're going to use. But you can reach out to me at 888-309-9705. Again, 888-309-9705. You can email me at jason@keyhomelending.com. Again, it's all going to be below, so don't worry about writing that out. But again, it's jason@keyhomelending.com, or you can just go to the website, www.reversequotes.com. That's a plural, reversequotes.com. You'll have a space. You can actually, you can see videos and see kind of screenshots of some seniors who I've helped. So you can see their testimonials, see what they thought about the process. And if you want to get in touch, just fill out the form on the far right, and we can pick a time to chat together. Listen, if you need help, think your retirement's kind of a little bit shaky and you want to get it on really solid ground, then I'm more than happy to help. Just give me a shout and I'll do my very best for you. All right, that's all I got. Till next time, take care of yourself.